Hello everyone, this is Eve. Today is Thursday, August 8, 2025, and I'm back to share the latest updates from the US stock market. The topic we're going to dive into today is, was Nvidia's earnings report really that bad? And why did the stock drop after hours? Well, it wasn't exactly a crash. The stock slipped about 3% after hours, which for most investors probably doesn't even feel that dramatic. Especially if you've been holding the stock for a while. Before we jump in, don't forget to hit the like button. Subscribe and turn on the notification bell so more people can see this show and so we're motivated to keep bringing you the latest market insights every day. Let's start with yesterday's closing numbers. The Dow Jones Industrial Average rose 3, the S&P 500 gained 2, the Nasdaq added 0.2%. The Philadelphia Semiconductor Index limped 3, and the Russell 2000 went up 6. Overall, heading into Nvidia's earnings, the market sentiment was leaning optimistic. And that makes sense. Nvidia's market cap has now surpassed $4 trillion. And its every move practically determines the direction of the S&P 500 and the entire US tech sector. Analysts broadly agreed that if Nvidia delivered a strong quarter, it wouldn't just lift its own stock price, but also fuel momentum across the AI sector and possibly even support S&P 500 earnings growth for the rest of the year. Friends, if you've been listening closely, you can already sense the bigger question. Is this a golden opportunity or just another Wall Street illusion? Drop your thoughts in the comments and remember to like and subscribe. Next time I'll bring you even more explosive insights. Now back to Nvidia's earnings. The company actually reported revenue and profits above expectations, but the stock still dropped after hours. Why? The main reason is that data center growth came in slightly below estimates, and on top of that, demand from China is showing signs of slowing, which means the growth rate just isn't as jaw-dropping as it used to be. We've talked about this before. Nvidia was posting triple-digit growth and sometimes 70-80 annual revenue growth, but no company can sustain that kind of pace forever. Growth has to normalize over time. From my perspective, if Nvidia can maintain 30-35 growth long-term, that's already extremely impressive. Combine that with its current valuation, and it looks like Nvidia stock is trading at a fair, not cheap, not overly expensive level right now. Looking at the broader market yesterday also supports this cautious optimism. Microsoft was up about 1, Apple gained 5, Google rose around 13. Amazon also edged higher, while Tesla and Nvidia both slipped. This shows the market was basically waiting for Nvidia's earnings to set the tone for tech. I also need to correct a mistake from yesterday's episode. I mentioned that Palantir CEO Alex Karp bought shares, but after fact-checking I realized I had misread the news. What actually happened is that last week, Karp sold around 400,000 shares of Palantir, priced between $142 and $157 per share, through an automatic trading plan. The main reason was to cover taxes related to restricted stock vesting. Even after that sale, he still holds about 6.43 million shares worth over $1 billion. So he clearly still has a massive stake, though markets often interpret insider selling as a signal of management's view on valuation. My apologies for the earlier confusion. Accuracy matters. Now back to the software space. Palantir shares fell to 6, but other software names like Salesforce and ServiceNow performed relatively well, in concerns about the SaaS sector. Investors have been worried about AI competition and budget tightening during economic slowdowns, but the latest earnings gave them more confidence. One striking example is MongoDB, which surged more than 38 yesterday, gapping above its 200-day moving average and erasing its losses from the past year. Over the last year, hardware-focused AI stocks have been on fire, rising at a 45-degree angle while software names lagged. But this earnings beat reminded the market of MongoDB's growth potential. Looking ahead, if the US market's bull trend continues, it won't just be about big tech giants. Software companies and AI application players will also become key opportunities investors can't afford to ignore. This quarter, MongoDB delivered an impressive earnings report. Revenue grew 24% year-over-year, reaching $590 million. While adjusted earnings per share came in around 1, well above Wall Street's expectations. At the same time, the company raised its full-year guidance significantly. Revenue is now projected between $2.364 billion and $2.373 billion, compared to the previous outlook of $2.34 to $36 billion. While EPS guidance was lifted to $3.64-$3.73, up from $2.94-$3.12, this clearly demonstrates management's strong confidence in future growth. So, what exactly does MongoDB do? Its core business is providing cloud-native NoSQL database solutions. Unlike traditional relational databases, MongoDB uses a non-relational architecture that's far more flexible, allowing it to handle diverse data types such as images, documents, and video files. With the rapid rise of AI and big data, companies are managing increasingly complex information ranging from structured to massive amounts of unstructured data. MongoDB's products are perfectly positioned to meet these demands for scalability and flexibility. The company's flagship offering is its database as a service DBaaS cloud model, which has become MongoDB's main revenue driver. Management highlighted that the AI boom is accelerating enterprise adoption of MongoDB Atlas, its cloud database service. In this quarter alone, MongoDB added 2,800 new customers, bringing total customer growth to more than 5,000 over the past year. The company now serves close to 60,000 customers worldwide. More importantly, it's not just about quantity but also quality. The number of large customers with annual recurring revenue are exceeding $100,000 grew 17% this quarter, reaching 2,564. Overall, our expansion hit 119%. Showing that existing customers are not only renewing but also buying more services and cross-product solutions. This drives stickiness and significantly boosts long-term customer value. For a subscription-based SaaS company, that translates into more predictable revenue and potentially higher valuations going forward. This is why the market reacted so positively to MongoDB's earnings. Its stock surged about 38% after the announcement. Meanwhile, another database giant, Snowflake, also delivered a strong earnings report. In after-hours trading, Snowflake shares jumped roughly 12%. Revenue for the quarter rose 31% year-over-year, surpassing expectations, while adjusted DPS of $0.35 also came in above estimates. More importantly, the company raised its full-year revenue forecast to $4.4 billion, up from $4.33 billion, underscoring management's confidence in sustained growth. From a stock performance standpoint, Snowflake has already climbed about 30% this year, outpacing most growth stocks. The company revealed that new products, especially those tied to generative AI, delivered revenue contributions well beyond market expectations. Product revenue rose 32% year-over-year, and customer count grew 21% in the quarter. Even more striking, over 6,100 accounts are now using Snowflake's AI tools on a weekly basis, reflecting the massive demand in this space. Taken together, both MongoDB and Snowflake are showing extraordinary momentum powered by AI. Their earnings not only validate the critical role of data management and database services in the AI era, but also send a clear signal that industry-wide demand is being lifted. Looking ahead, if the Federal Reserve does move into a rate-cutting cycle in the second half of the year, lower capital costs could further fuel the expansion potential of these high-growth companies, paving the way for the next leg up in valuations. So, if the stock can hold near its 200-day moving average, and if there's enough capital-driven momentum to break through overhead resistance levels, I believe there's still a chance for a new upward trend to emerge. By contrast, some of the AI-related stocks that have already run up significantly now have limited trading opportunities at current levels. This is why I think shifting focus to select software names could open up attractive entry points in the coming months. Another area worth discussing is cybersecurity. Beyond data, AI's rapid development will inevitably create a surge in demand for security solutions. Since everything is now online and cloud-based, cybersecurity is becoming increasingly critical. Take Okta, for instance, a growth company focused on identity authentication and security. Its stock performance after earnings was relatively weak. At first glance, its chart even looks somewhat similar to what we just discussed with Snowflake, so the resemblance in technical patterns may confuse some investors. I did mistakenly show the wrong chart earlier, but the information is correct. Looking at Okta's fundamentals, this quarter's EPS came in at $0.91, while revenue grew about 13% year over year to $728 million. That said, it's important to separate fundamentals from technicals. Technically, the stock still faces overhead resistance. Fundamentally, growth is intact. However, since Okta has not yet reclaimed its 200-day moving average, investors may want to wait until the stock establishes support above that level before getting more aggressive. As for Snowflake, yes, the stock has climbed about 30% this year, but it still remains in a broad consolidation pattern. We'll dive deeper into its charts in a later update. But for now, investors can check the latest technical setup themselves. Business-wise, Snowflake remains focused on its cloud data platform, and management continues to express optimism about long-term growth prospects. Back to Okta, its business is heavily tied to identity verification and government contracts. For example, contracts with the U.S. Department of Defense have historically been an important revenue source. In the latest quarter, the company noted that government contracts remain stable, though not particularly strong. Still, they expect demand to pick up in the second half of the year, and they also pointed out that uncertainty surrounding U.S. government deals is easing. Based on this outlook, Okta raised its full-year guidance for fiscal 2026. Moves like this often boost market confidence, since when management chooses to lift guidance, it usually signals that they're seeing growth drivers the broader market hasn't fully priced in yet. From a technical perspective, Okta continues to trade below its 200-day moving average. Whether or not it can break above and hold that level remains the key battleground between bulls and bears. If it does, the stock could attract stronger buying momentum. Now let's turn to CrowdStrike, another leader in cybersecurity and one of my personal favorites, a stock I've followed and traded since before the pandemic. Historically, its stock performance has been strong. In the latest quarter, revenue grew 21% year over year, with adjusted DPS at $0.93, beating market expectations. Adjusted annual recurring revenue rose 20% to $4.66 billion. Management also emphasized that rising AI-related security demand supports a positive outlook for the future. Full-year revenue is now projected in the range of $4.75–4.8 billion, while adjusted DPS guidance has been raised to $3.63–72, above the prior consensus of $3.5. This suggests that software company management teams were initially conservative in their outlook due to uncertainty. But as the noise in the market eased by midsummer, they began revising guidance upward in response to stronger-than-expected trends. That said, CrowdStrike stock slipped about 4% in after-hours trading. The short-term pressure stems from the well-publicized Microsoft outage earlier this year, which was ultimately traced back to a faulty CrowdStrike update, not Microsoft systems. This incident still weighs on the company's reputation and business in the near term. To mitigate the impact, CrowdStrike introduced more flexible customer options, such as the Flex program, allowing clients to stay on the platform and gradually expand subscriptions. Currently, Flex customers have surpassed 1,000. Additionally, the company acquired identity security startup Port to broaden its security platform and extend its product coverage. On the technical side, CrowdStrike remains in a longer-term uptrend, but its stock has pulled back toward the 200-day moving average. Personally, I'd prefer to re-enter around the 200-day level rather than attempting to bottom fish. The reasoning is twofold. First, the company's broader trend is still upward. Second, the 200-day moving average is a critical line between bullish and bearish sentiment. If the stock were to break down below it, a deeper correction could follow. I usually treat the 200-day moving average as a key level of support when a stock approaches that lower boundary. You can first define the amount of risk you're willing to tolerate. As long as the risk is under control and the fundamentals remain intact, it makes sense to consider taking some action and see whether the stock finds support at that level and continues its upward trend. Even if the future move doesn't go as expected, at least you'll already have a clear sense of your potential downside. That's why I believe these moments often represent better entry points for companies with competitive advantages in the market. It's definitely a better setup than buying into companies stuck in a prolonged downtrend where there's no visible bottom in sight. Alright, now let's finally move into today's main topic, Nvidia. We've already talked about Nvidia several times over the past few days. Personally, I was hoping to see the stock pull back after earnings because chasing it at fresh all-time highs carries a lot of risk. If you were to jump in at that point, you'd run the risk of being stuck in a drawdown for some time. Of course, I also know that most people already have some exposure to Nvidia stock. Even if you haven't bought it directly, chances are you own ETFs like SPIRE QQ, both of which count Nvidia among their top holdings. That means Nvidia's earnings results are relevant to practically every investor. So why did Nvidia's stock still fall after this quarter's earnings release? Hello everyone, I'm Eve, an investor who focuses on US equities. If this is your first time seeing my channel, please hit the subscribe button. You'll find the most objective US market analysis here, and if you enjoy the video, don't forget to give it a like for support. Now let's take a look at Nvidia's most recent quarterly performance. Revenue came in at $28.06 billion, up about 6% sequentially and up a massive 56% year-over-year. While growth is still over 50, many analysts have pointed out that it's slowing noticeably from 70 to 80 in prior quarters down to 50-60 now. That's raised concerns in the market about whether Nvidia has already peaked, but in my view, this is simply part of the normalization process. Sustaining extremely high growth rates for multiple consecutive quarters isn't realistic. A moderate slowdown actually suggests the industry is transitioning into a more stable growth phase. This quarter, earnings per share EPS came in at $1.08. Up around 60% year-over-year, with earnings growth still outpacing revenue growth. This is a critical point, as we've discussed before. One way to measure a large-cap company's competitive advantage is by looking at whether EPS or net income growth consistently outpaces revenue growth. If it does, that indicates the company is leveraging cost efficiency, scale, and pricing power to further strengthen profitability. In other words, Nvidia's competitive edge remains intact. Adjusted DPS was $1.05, up 8% year-over-year and also ahead of market expectations. The market's main focus, however, is still on the data center segment. This quarter, data center revenue reached $41.1 billion, up 56% year-over-year and up about 5% sequentially. The growth drivers include AI large language models, recommendation engines, generative AI, and even AI security agents, all of which are fueling strong demand for data center solutions. Within that segment, the networking business stood out, with revenue of $7.3 billion, up 98% year-over-year, well above the overall data center growth rate. The growth was driven by the adoption of GB200 and GB300 architectures, as well as the broader rollout of NVLink and InfiniBand high-speed interconnect technologies. As more customers adopt these advanced networking solutions, the segment is seeing particularly strong momentum. Meanwhile, the latest generation Blackwell series GPUs are also demonstrating extremely strong market demand. Revenue from Blackwell products grew about 17% sequentially this quarter, since Blackwell GPUs carry higher price points and stronger margins. They are making a significant contribution to overall profitability. CEO Jensen Huang emphasized that Blackwell is the long-awaited next-generation AI platform, delivering cross-generational performance improvements. He noted that Blackwell Ultra has already entered full-scale production, with demand so strong that supply is struggling to keep up. In essence, the platform is in a sold-out situation. In the second quarter, many people were also watching how Nvidia performed in China. The company noted that it didn't sell any H20 chips to Chinese clients during this quarter. However, by using some previously reserved inventory, it still managed to generate about $180 million in profits from China, while also selling roughly $650 million worth of products to customers outside of China, which weren't subject to restrictions. So while China remains a factor, its overall impact is relatively limited and was already reflected in earlier stock price moves and earnings. In other words, there wasn't any significant shock this quarter. As for gaming, year-over-year growth accelerated from 42% in the prior quarter to 49% this quarter, marking a record high in single-quarter revenue. This strong performance was largely driven by improved supply of Blackwell GPUs. Meanwhile, professional visualization grew 32% year over year, and both robotics and automotive revenue posted growth of over 70%, highlighting strong momentum across Nvidia's diversified business lines. One detail in this earnings report that really reassured me was gross margin. Adjusted gross margin came in at 72.7%. While that's down about 3 percentage points from a year ago, it still beat market expectations. The company guided for gross margin between 71.5% and 72.5%. Being able to sustain margins above 70% is an excellent level, underscoring Nvidia's strong pricing power, product competitiveness, and market leadership. The company also showed a strong commitment to shareholder returns. In Q2, it returned $24.3 billion through buybacks and dividends and added another $60 billion to its repurchase authorization with no expiration date. This not only boosts shareholder value but also strengthens market confidence, especially meaningful given how high the stock price already is. Looking ahead, Nvidia guided for around $54 billion in revenue next quarter, with adjusted gross margin at about 73%, roughly in line with consensus. However, some analysts had set higher expectations closer to $60 billion, which left the market somewhat disappointed after the report. It's worth noting that this guidance doesn't include potential revenue from Chinese data centers or possible export restrictions, so it's inherently conservative. That cautious outlook is probably one of the reasons the stock sold off post-earnings, rather than any real deterioration in fundamentals. The real question is, what will be Nvidia's next catalyst after earnings? As the market digests this quarter's results, the next wave of momentum may come from product cycles. The GB200 and GB300 are close to full-scale production, and future architectures like Vera and Rubin are on the horizon. Some analysts even forecast that by 2028, Nvidia's revenue could surpass $300 billion. Roughly a third of the entire semiconductor industry, cementing its leadership in AI and chips. History shows that the largest companies by market cap change with the times. It used to be Apple and Microsoft. But today, Nvidia has become the clear market leader on the back of the AI boom. And this isn't just a short-lived hype cycle, it's a long-term trend and a profound industry shift. As long as AI keeps advancing, Nvidia's dominance will be extremely difficult to challenge. Competitors may try to catch up, but closing the gap in market share could take years, and in such a fast-moving industry, the competitive landscape can change quickly. Which is why ongoing monitoring is essential. That said, from an investment perspective, the key question remains, with the stock pulling back, should you buy Nvidia now? Looking at valuation, its forward P/E is about 36x, compared with a 5-year average of roughly 42x. On a relative basis, that looks slightly cheaper than normal. But keep in mind, during those years, Nvidia was in a hyper-growth phase, so a higher P/E made sense. If we look at growth, analysts project Nvidia's annual earnings growth to be around 30-32. Combining that with valuation, Nvidia's current PEG ratio looks reasonable. In other words, it's not dirt cheap, close your eyes and buy, but it's also not so expensive that it's untouchable. The stock is in what I'd call a fair value range. For it to move into more expensive territory, we'll need fresh, powerful catalysts or a renewed wave of AI optimism. Typically, lofty valuations happen when the market is irrationally euphoric, but Nvidia's hypergrowth story has already played out over the last 2 to 3 years. Now, the market is applying more rational and stricter standards. That's why, when earnings or guidance don't deliver extra surprises, even if fundamentals are fine, the stock can still swing sharply and pull back. Still, the big picture remains intact. Nvidia is in a long-term uptrend. The current stock price already reflects much of the market's expectations. So future upside will likely depend on new product launches, AI chip advances, or breakthroughs across the AI supply chain. Any fresh wow factor could push the stock higher again, so can you buy Nvidia here? I'd say yes, but this is a stage where dollar cost averaging or scaling in makes more sense. For example, if you don't own any shares yet but want to get in, you could start with 1/3 of your planned allocation. If the stock dips 3-5, add another third, and then complete your position based on how things develop. This way you spread out your risk and smooth your cost basis rather than going all in at once. For those who already hold shares, I don't see the need to sell everything. You could trim some profits to manage risk, but a full exit doesn't make much sense, especially if your cost basis is far below the current level. In that case, just hold on for the long run. Alright, that's it for today's breakdown. If you found this analysis helpful, make sure to like, share, and subscribe. See you in the next video.